Yeah, good evening, everyone. And namaste to all. It's truly an honor and privilege once again to welcome all of you for this very important webinar today. We have, and as an expert, I would say the panelist, fortunate and privileged to have CA Dr. Chinnaswamy Ganeshan and CA Sarthak Jain. Thank you, both of you, for being here today, sparing your valuable time, and for, I think, one of the very interesting and important topic which we'll be covering, the AS14 and the Ind AS 103, both amalgamation business combinations. And I'm sure the participants would really be benefited with the questions which will be taken will be taking through the entire session of this 2 hours. I think would be an opportunity for each one of us to hear the experts. And of course, we have the moderator, CM Mayuri Daga. Welcome, Mayuri, and the office, Shalini, and of course, the technical support which we always get. So from the ASB, like I was sharing, that we have been doing a lot of such events, both physical as well as webinars. But this is one initiative which we have taken for some time, that at least for fortnightly or within a month's time, we organize such important or we pick up topics which are really important in the interest of the members. More importantly, the AS and the Ind AS, because there are certain, sometimes you have revisions, and it's more important for us to understand or do a deep dive of these subjects. We have those experts who come share their experience, and none other than the two experts, I would say a combination of experience and a young, energetic and dynamic professional with his experience. We'll have, I'm sure, a very good interaction. Members would really be benefited. And I once again welcome all of you on behalf of the Accounting Standard Board. And I think we have, I would say we'll have less time because we'll have more questions to respond, but still we'll try our best from the committee and from the experts. We'll request that whatever questions maximum we can take up. And from the participants, do we have any questions? Still, if there are any questions left, we'll try to respond them later if possible. But we'll try to, at least collate all such questions. So over to you, Mayuri. Thank you very much. And once again, welcome all of you for this webinar.
Thank you. Thank you so much for your words, sir. And I welcome the chairman, sir, and the vice chairman, and the sir of Accounting Standard Board. And I'm pleased to be part of this seminar. And I embrace the presence of our expert panelist, CA Dr. Chinnaswamy Ganeshan and CA Sarthak Jain. Today we will be discussing or talking over an elaborated topic of 104, Ind AS 104, accounting for business combination and accounting for amalgamation in AS 14. Now, without any further ado, I would quickly jump to the questionnaire, and I would be speaking to our panelist. So, sir, this question is for Dr. Ganeshan, sir. Please highlight the basic difference between AS 14, accounting for mergers and amalgamation, and AS 103 on business combinations. So you're on mute, sir.
Thank you, Mayuri, and thank you, the Accounting Standard Board, for giving this opportunity of meeting all of you on this highly complex technical standard. As you rightly pointed out, when we are talking about AS 14, we are simply talking about mergers. And the mergers, the way in which we account as per AS 14, can be done with a pooling of interest method or purchase method. That's the way in which AS 14 has been drafted. But if you see Ind AS 103 business combination, it is talking about combination of business. So one entity taking control of another entity by any means, even without actual transaction. For example, if I have, say, just 40% shareholding and I don't have a control, I have only a significant influence, but the other shareholders are very scattered and they don't have a group. And in the process, if some buyback is happening and some people have actually offered their interest in the buyback, and I will become one strong person who will be having control over the entire operations of the entity. Even with an event, it may become a business combination for me. So I will be having control over that entity. So accordingly, the first and foremost point which we are looking for is that how the accounting should come when we are talking about AS 14 vis-a-vis Ind AS 103. AS 14 says that you can either use purchase method or pooling of interest method as an accounting policy choice. Whereas Ind AS 103 makes that in all the business combinations, you should use only acquisition method. So acquisition means the day on which you have the control over the other entity. So you have to start accounting that as a purchase or acquisition. The pooling of interest method, of course, is also permitted, but only if the business combination is arising out of a common control transaction. That's a major difference in which we are looking for in the accounting perspective. And of course, the other major issues which we can think about it is the way in which goodwill is accounted for in AS 14. And of course, we have done a carve out also with respect to the capital reserve for Ind AS 103. So the goodwill accounting in AS 14 and 103 will be the same. But only problem is in Ind AS 103, we never amortize that goodwill because we believe that the goodwill is an indefinite economic useful life intangible asset, and accordingly, it should be only subjected to annual impairment testing. Whereas if you see in AS 14 amalgamations, it actually says that goodwill should be amortized over a period of 5 years. So that is also another accounting difference which we are having. This, I think that it's a major one. And another possibility is under AS 14, an entity can even account the transactions based on cost of the assets acquired, liability taken over, and then identify what is the goodwill or capital reserve arising out of that particular activity. Whereas in respect of Ind AS 103, you are supposed to do a fair valuation of all the assets taken over, all the liabilities assumed, and then you have to compare with your purchase consideration to arrive at your goodwill or capital reserve as the case may be. So these fundamentally comes with a little bit of complexity compared to AS 14. That's what my initial reaction on your questions.
Thank you so much, sir. With that, the next question I'm asking Mr. Sarthak Jain, sir. Sir, please, what are the changes in accounting treatment for mergers and acquisitions has after the introduction of Ind AS 103 business combinations?
Sure. Thank you, Mayuri, for the question, and thank you, ICI, for the giving us an opportunity to interact in this webinar. And to answer your question, I think pretty much to add on to what CA Dr. Ganeshan sir said, is there are plethora of changes when it comes to business combination coming from amalgamation. The very first basic change, if I talk about the accounting aspect, is that accounting standard 14 is more of a form-based acquisition accounting prescribing standard, whereas Ind AS 103 is a more substance-based accounting prescribing standard, which essentially means that in case if, let's say, for example, there are two different companies and one company acquires the other company, which were ultimately both controlled by the same set of entities earlier, under accounting standard, there used to be a legal format or the contract which used to specify the accounting, that if you fulfill those 5 conditions of fulfilling the pooling of interest method, what we used to call as the merger, then in that case, you will do your accounting that you will just combine the two balance sheets. Whereas here under Ind AS 103, what essentially needs to be first at the very first place checked is whether there is an acquisition of control. That means, is the control changing hands or not? That means pre and post the contract, have the owners changed? And if that is the case, then it says that essentially what you are acquiring, for that, what you are going to pay is not going to be equal to the sum total of the value of the assets net of liabilities which you take over. And you possibly would be paying an additional consideration, which we would call as goodwill. If we form an equation, that would be nothing but a purchase consideration less the value of net assets less of liability which we have acquired, and that would be goodwill. So if I talk about the accounting aspect, Ind AS 103 gets into more details when it comes to prescribing that how to calculate fair value of various assets which you have acquired, what are going to be the deferred tax implication on the acquisition which you do. Accordingly, the corresponding difference, which is going to be the goodwill, how that would be accounting. As my counterpart explained, that goodwill accounting is very different when it comes to Ind AS in comparison to the accounting standard. So I would, in nutshell, because obviously we are discussing the whole standard, so we'll get into more details and niceties of the individual points. I think the basic difference culminates to the fact that one, here it is only if there is a change in control, the accounting for business combination applies. Second, there has to be a business element involved. If A Limited absorbs B Limited, but there is no acquisition of business, it's a dead business. We're just acquiring a closed factory, which is, let's say, a dormant company of B Limited, not a business, then the standard does not apply. And if the standard applies, then in that case, the accounting prescribed here is much, much more detailed, more elaborate, prescribes on everything, what is, how to calculate the value of assets, liabilities, purchase consideration, and goodwill and their accounting treatments.
Thank you so much, sir. With that, with the answer of Sarthak, sir, I get to know that there is some business combination, or the definition of business is there for application of Ind AS 103, I think. So with that, the definition of business. So business as per Ind AS 103 is, I think, a business consists of inputs and substantive processes applied to those inputs that have the ability to contribute to create the output. With that, a case study or a question of practical question is that a business, suppose a business consists of 3 sets of inputs and processes, say IP1, IP2, and IP3, out of which IP3 is a substantive process for producing output. If only IP3 is acquired by another entity, is that called a business?
It's true that this standard very clearly mentions that when you have to apply this business combination. So only if you acquire a business, then the business combination standard will apply. As rightly pointed out by my counterpart, in case if you are only acquiring a group of assets, then you could not apply this particular standard. You have to go to the respective standard, maybe Ind AS 16 on property, plant, and equipment, or Ind AS 38 on intangible assets, as the case may be. So accordingly, the definition of business is very, very critical for the purposes of determining whether a particular transaction will fall into business combination or not. In the example which you have talked about, you are talking about IP1, IP2, and IP3. And in all the 3 cases, you are also saying there are inputs, processes, as well as outputs. And if the entity chooses not to purchase IP1 and IP2, but IP3 is substantive process required for bringing the outputs. And the IP3, when I'm talking about, it also contains certain, I'm assuming, are extending the background for the question which you are talking about, because you are saying it's an input process. So IP3 is also an input process, so it contains inputs, and it is substantive process for getting the outputs. That means it can be processed as well as it will give the outputs. So in those scenarios, if I am acquiring a substantive process for manufacturing goods, the intention is not only purchasing the asset, but also to purchase the entire business activity. And accordingly, in my view, if the entity decided not to purchase IP1 and IP2, but only going to purchase IP3, which has the substantive process for manufacturing of the goods, still it will constitute a business, and this standard can be applied.
Yeah, thank you so much, sir. With that, I'm asking Mr. Sarthak Jain, sir, if the business to be acquired have inputs and substantive processes, but no output, is it called a business combination as per Ind AS 103?
Okay. So because, the Ind AS 103 business combination culminates only from the fact that if you're acquiring a business, the standard becomes applicable. It is important for us to understand what exactly a business is. Pretty much, as Sir said, that you need to have substantive processes taken over. And that is what would differentiate an asset acquisition with a business acquisition. Now, the question which comes up is what Mayuri, you have asked is that I am acquiring, let's say, for example, a set of assets and also processes along with it, which are not generating outputs already. That means there are no sales, if I talk in layman terms. Would that constitute a business? Ind AS says what is essential for definition of businesses inputs and processes. What is not essential is outputs, which means that, let's say, for example, I have constructed a building which I intend to run as a hotel down the line. I've done all my processes are ready. I have created a workforce who's all ready to inaugurate that particular building. And one fine day, another chain of hotels come in and they say that we want to acquire your business or hotel. I said, I've not already started it, but then they are still okay with acquiring it. Would it mean that they have acquired a business? I think yes. Why? Because they are acquiring an asset, which is obviously the land building and also the processes. But here, what could possibly happen is that where you're not having a running business, which is creating output, it would be very difficult to establish or mention that we are acquiring processes which are already in place because you're not generating outputs for that matter. That is why Ind AS specifically says that if you're acquiring an entity which is already generating outputs, then processes could be either acquisition of the workforce or a documented process through which your own workforce using that process can apply and execute the business activities. However, if you're not already generating outputs, then in that case, it is essential that what you are acquiring is not just the set of assets and a documented process. You need to also acquire the workforce which is habituated or can use the documented process to create outflow. If that is proven, even without zero revenue or zero output, you can say that there is an acquisition of business.
Right, sir. Further, in relation to that only, I'm asking Mr. Sarthak Jain, sir, how acquisition-related costs to be accounted for according to Ind AS 103? Acquisition cost, not the assets and liquidation cost or something like that.
Sure. So here also there is a big difference between Accounting Standard 14 and Ind AS 103. In Ind AS 103, any acquisition-related cost is to be charged off to P&L. First, what's an acquisition-related cost? Simply, when one company is acquiring another company, there would be a lot of legal costs which will be included. There will be consultant fees. There would be stamp duties to be paid. All these costs are to be charged off to P&L, which is very surprising because under accounting standard, we used to treat it as a cost of purchase, not purchase consideration, but we used to add it to PC and consequently, it used to increase the goodwill under accounting standard. But that is not the case under Ind AS. Reason for that is Ind AS says that I am acquiring all assets and liabilities at fair value, subject to very few exceptions. Now, if I'm already acquiring assets and liabilities at fair value, then there is no concept of looking at the cost side in terms of what am I paying for it. So the whole concept of 103 is one side you look what assets and liabilities you've acquired, value it at fair value. On the other side, you see what you are paying for these assets and liability and difference you treat it as goodwill. Any cost which you have to additionally incur in form of consultant fees, legal, stamp duties and others are not going to enhance the benefits which you are getting from the asset. Hence, you should charge all of that to profit or loss. There's just one noted exception to this, which is when you're acquiring a particular business, the consideration which you are paying, if it is in the form of, let's say, issue of your own debentures or equity shares, and there is a cost relating to that, which essentially means that we see a lot of times that one company acquires another company and the consideration to some extent is through equity settlement. So the cost for issuing the equity or debenture or any other similar financial instrument would be accounted for under Ind AS 32-109, which essentially would be that if it is relating to issue of equity, it will be adjusted directly from reserves, not through PLL. If it is relating to issue of debentures, it will be amortized over the life of the asset. So to conclude, any cost, whether it is legal, consultant fees, even cost of registry, because you'll have to possibly change the immovable properties to your own name if there is an acquisition happening, or any other cost other than debt equity issue related cost will be charged to PRL. Debt equity related will be accounted for under financial instruments.
Okay. Thank you so much, sir. My next question to Dr. Ganeshan, sir. Suppose there is a company A Limited who acquired B Limited company. the acquiree has service contracts to supply certain items to railways. Now, should these service contracts be treated as separate intangible asset?
Okay. Normally, when an entity is having certain assets which are reflected in the balance sheet, we don't have any issues in doing a fair valuation of those assets, and then based on which what is the net assets taken over, identifying the goodwill, etc., is very, very simple. But Ind AS 103 gives some sort of challenges to also say that there is any identifiable asset, meaning what? What is not appearing in the balance sheet, but it may be appearing outside the books of accounts, and that can be having a value for the acquirer. In that case, that is also an asset which you are taking over, and that should also be recognized as an asset so that the value of your goodwill will come down. In simple terms, goodwill should always be a residual value. And accordingly, whatever assets which you can identify and recognize at fair value, that should be part of it. In this example, what you were trying to say is that there are some contracts which the entity has entered into with railways, and that is being acquired by the acquirer. That company is being acquired along with the contracts which they are also having. So the moment we are saying that there are contracts which we are having, and that has a value but not recognized as part of an asset, whether it will create some sort of additional benefit to the entity. The moment you say that there will be an economic benefit to the entity, then it will meet the criteria of an intangible asset as under Ind AS 38. So I assume that the service concession arrangement, which the entity is having with the railways, will also have the possibility of creating additional value or additional revenue for the entity. And to that extent, it will be an identifiable asset. And accordingly, the recognition will come into the picture. But having said that, the moment you recognize an intangible asset which is in relation to service construction arrangement, you should also look at what the way in which your service concession arrangements will be accounted for in accordance with Ind AS. Because in IGAP, you normally consider it as an intangible asset, and then you will amortize that over the period of the contract, whereas in service concession arrangement, the accounting is completely different. It is like a contract cost. So your accounting as an asset, initially it's possible, but the way in which you have to account for the revenue arising out of it or the contract cost which you have to account for, that will be in accordance with the service concession guidance given in the standard. That's the way in which you have to look for.
Yeah. Thank you so much, sir. Now my next question to Sarthak Jain, sir. What are the key differences in accounting of asset acquisition and a business combination? So there is a, if there is only asset acquisition, what is the accounting, and the whole business combination, what is the accounting? So you're on mute, sir.
Thank you. So there's a key difference between both these accounting, because asset acquisition is pretty straightforward. It is based on the cost principle. What is the cost principle? Says that initially you should record everything at cost. So let's say, for example, if I'm acquiring a land for 100 rupees, I will record it at 100. If I say that the land had a fair value of 100 crores, but through my negotiation, I had acquired it at 90 crores, I would still say that I would recognize it at 90 crores because that's my cost. I was not a very good negotiator. The sellers was better. And I had, let's say, for example, for some reason, purchased it at 105 crores. The fair value could be 100 crores. My purchase price is 105 crore. I will still record it at 105 crores, which means asset acquisition, whether it is one asset or a set of asset, a slump purchase of asset. In every case, whatever is the cost is the initial recognition value of the assets which are acquired. This whole concept is tossed over if I get into business combination. If it's an acquisition of business, then I do not presume that what I have paid is only for the value of asset. And there is something which is invisible. What Sir said, something which is unidentified, something which is not there in the balance sheet and is also not existing, something which we can basically identify, but is still there, which is becoming the reason for my additional payment. And that is what usually would be a goodwill. So in business combination or acquisition, instead of comparing or allocating my cost to a set of assets. If I'm acquiring a set of assets, what I rather do is I go the other way around. I calculate the fair value of the assets and liability which I have taken over, and I compare whether is it equal to the cost which I have paid. If I've paid more than that, I would say the difference, as sir said, residual value, the residual value or the balancing figure, the difference would be for goodwill. So it is assumed that is my cost of goodwill. And in case if I make a bargain gain, which means I have acquired a business which has net assets worth 100 crores and I have acquired it at a consideration of just 90 crores, I would recognize all the assets totaling at 100 crores. And I've just paid 90 crores. So the difference 10 crore is something which I will recognize as a gain, which under the Indian context would go to capital reserves, could be through the other comprehensive route or directly into the reserves. So there is a big difference. And if you are a business combination, only then 103 would apply.
Thank you so much, sir. Now comes my next question to Dr. Ganeshan, sir. So there's like acquisition date. There's something like acquisition date when we will account our business combination. So there's a case study. Suppose there is a company ABC Limited, and it acquired all the shares of company XYZ Limited. The negotiations had commenced on 1st January 16, and the agreement was finalized on March 16, while ABC Limited obtains the power to control XYZ's operation on 1st March 16. The agreement states that the acquisition is effective from 1st January 16 and that ABC is entitled to all the profits after that date. In addition, the purchase price is based on XYZ net position on 1st January 16. What would be the date of acquisition? So is it January 1 or March?
Before getting into the question, maybe we will just look at the standard, what it talks about the acquisition date. After you have identified who is the acquirer, the next important step in the standard is to identify what is the acquisition date, because that is the date on which the business combination is given effect in the books of the acquirer. So if you see the acquisition date, the paragraphs are very, very clear that when you are looking at maybe paragraph 8 or paragraph 9 of Ind AS 103, which talks about the acquisition date, they are saying that the date on which the acquirer obtains control over the acquiree is the date of acquisition. So with that background, if we are looking at the given illustration in the question, even though the transaction has been completed or the finalized on March 2016, but if you see that the date on which the entity has the control over the other entity is on 1st of January 2016. And also it has been mentioned that they are entered into an agreement very clearly stating that from 1st of January 2016 negotiation has started,
yes,
but agreement has been finalized on 1st of March. The operations, control over the operation have started on 1st of March 2016. Sorry, I have made it a little different. So what it says that the acquisition will be effective from 1st January 2016. And there is an agreement which says that you will be entitled for the profit also from that particular date. And the way in which you have to account for the fair value of the assets and liabilities are also from 1st January 2016. From this example, what I am trying to understand that the control which you are talking about as 1st March 2016 may be the date on which they have entered into the board of the company, or maybe they have appointed the respective key management personnel to take over the operations of the entity. If you see the paragraph which has been given in paragraph 19, it says the date on which the acquirer obtains control of the acquiree is generally the date. So it is not specifically saying that it is the only date. Generally the date on which the acquirer legally transfers the consideration, acquires the assets and assumes the liabilities, However, the acquirer might obtain the control on a date that is either earlier or later than the closing date. So, if there is an agreement which says that this agreement provides or the acquirer will obtain control only after a particular point of time, you have to look at all the factors arising out of it. In the example which you are talking about is only thing which has been seems to be in a different scenario is that the profit arising from 1st of January 2016 is also entitled for the acquirer. The agreement very clearly says that the control will be passing only on 1st of March 2016. And the basis for calculation for the assets, etc., is coming from 1st January 2016. Accordingly, I believe that even though the agreement has given as of 1st of January 2016, the actual control has been taken over only on 1st March 2016. And that will be the date on which you are supposed to work on your business combination. But maybe the valuation which you will be doing will be on 1st of January 2016. That is from the guidance given in paragraph 8 and paragraph 9 of Ind AS 103. We have to look at what is the date on which actually the control passes on. So control may pass before or after the date of the agreement. So in this case, after the date of the agreement, it passes. So I think that we should take 1st March as the date.
Right, sir. So maybe the agreement was made on, or whatever the agreement was made on another date, but the actual the control of power on later date. So later date would be considered as the date of acquisition.
Correct.
Right. So my next question to CS Arthik Jain sir. This is regarding, I think, acquisition cost. Should stamp duty paid on acquisition of land pursuant to a business combination, be capitalized to the cost of the asset, or should be treated as an acquisition related cost and accordingly be expensed off?
Okay, so this is, just to add on to what we discussed earlier, that any acquisition related cost in business combination would be expensed out. Same would be the case in this scenario. In fact, the CA Institute has also issued a clarification on the same particular thing, that when you acquire another particular business, it may so happen that you may have to incur stamp duty cost to change the name or the holder's name in terms of the immovable properties. Any cost relating to that cannot be added to the cost of asset and will be charged off to PRL. Reasons same, that in business combination, we otherwise value all the assets at fair value. So we don't want to load any other cost over and above to it. And it is also giving me no further benefits apart from acquisition. That's the reason it is charged off.
Yeah. So another case study for Dr. Ganeshan sir. Yeah. So this is regarding.
Say that we're setting my CA final examination to check whether I am able to qualify or not.
Yeah, yes.
I'm having a better luck today.
Yeah.
Very interesting questions. Very nicely drawn questions, I should say, Mayuri.
Yeah, thank you so much, sir. So this is regarding contingent liability, how the assets and liabilities acquired in a business combination. If it is a contingent liability, how we should recognize it. Suppose there is a ABC Limited company is in the process of acquiring PQR Limited, an entity engaged in the business of software related products and services. PQR Limited has been sued for one of the software licenses it uses in its business. The entity's lawyer has advised that, in his opinion, it is probable that the case could be successfully defended, and accordingly, no provision has been included in the PQR Limited's financial statements immediately prior to the acquisition. However, post-acquisition, ABC Limited's management has decided that the case should be settled out of court in order to avoid a protracted court case. Should the acquirer recognize this as contingent liability? So,
okay. So this is something interesting when it comes to contingent liability accounting. The reason why we are talking about this particular case is that if you see Ind AS 37, so we will come to from the background. Ind AS 37 says a contingent liability arises from past events and there could be a probable outflow based on future events. So otherwise you will not recognize any contingent liability. Contrary to that, if you see the guidance given for contingent liability in Ind AS 103, if I'm not wrong, it should be paragraph 23 of paragraph 23 of Ind AS 37 is talking about that. Contrary to that particular paragraph, paragraph 56 gives the guidance of how you have to do it in respect of Ind AS 103. So paragraph 56 of Ind AS 103, you have to look at for the accounting of contingent liability. So the acquiree has decided that it's tenable, and accordingly there will not be an outflow which may arise in the situation, and accordingly there is no need for recognizing any contingent liabilities. They only disclose that as a contingent liability. Maybe when I am assessing this, we talked about concept of identifiable assets and liabilities. So when I am identifying a liability, I also assess whether this contingent liability will be part of something which will be settled. For example, in this case, they have said that the lawyer of the acquirer has told very clearly, legal counsel has told very clearly that it may not be 100% sure that they will be win the case, and accordingly the entity has decided that they will go for an out-of-court settlement. So the moment they are thinking that there could be an out-of-court settlement which will arise, and to my mind, as per Ind AS 103 read with paragraph 56, the entity should recognize that as a contingent liability at that point of time. And of course, there are two ways of accounting for it. One, if the entity believes that they have already decided when they are acquiring this, they might have definitely gone for a due diligence. In the due diligence, this item might have came in. They might have consulted the legal counsel and they identified whether there could be a possibility of outflow going to happen. If they decided that there will be a settlement of the liability outside the court, they have decided, they might have already thought about that there will be a possible outflow. Definitely, they are going to have an outflow. In that case, it will constitute a liability. Maybe I can say that it is contingent to that extent their assessment is. But as part of the identifiable liability, I have to recognize that and do the accounting for my goodwill or capital reserve as the case may be. The second scenario could be little technical. Suppose if I believe, no, I am still having an assessment. If I have not yet decided whether I will go for an out-of-court settlement, try little more time and see what is the outcome which is arising out of that. In that particular scenario, maybe a 1-year window is available under Ind AS 103, which talks about a contingent consideration. So I assume that the settlement will also part of the business combination outflow. So I consider that instead of the acquiree paying that liability, I will be ready to pay that liability if arising at a later point of time. So if I consider that as part of my contingent consideration, I will settle it on behalf of the acquiree. I can use the accounting principle which has been given in contingent consideration. So in the contingent consideration, within 1 year from the date of accounting for business combination, you can adjust the number from provisional accounting to actual accounting. So within 1 year, you can go back and readjust all the numbers, including your goodwill and capital reserve. So there are two ways in which you can look at. My preference in this case is, if they have already taken the view of the legal counsel at the time of entering into the agreement for acquiring this, they are 100% sure that they are going to have an outflow. So in that case, it is an identifiable liability. They have to take it as part of that. To that extent, the goodwill will have an impact when they are accounting for it. That is my choice of accounting. If the entity is feeling that let us take some more chances, then they have to disclose that as part of the contingent liability, and they can adjust that. It's a provisional accounting. If anything arising within 12 months, they can readjust that number. That is also another way of looking into this.
Okay, thank you so much, sir. My next question to CS Arthur Jain, sir. How the lease acquired in business combination be accounted for?
Okay. So leases in itself is a complicated topic, and so is 103. And we have a question which combines both of them. So it's going to be very interesting and challenging for the viewers. Leases accounting, I'll just touch upon on the accounting for lease very briefly. If I am a lessee, which means I have taken an asset on lease, I would apply Ind AS 116, which would say that unless and until I go for a exemption for low value asset, which is more so based on the materiality grounds, Or if the lease is not for more than 12 months, it's a short-term lease, so it really doesn't make too much of a difference to apply the accounting principles of 116. The usual accounting for lessee for a lease is pretty simple. You just have to see what are your committed lease payments, and you need to discount those future lease payments considering an interest rate, which would be provided by the lessor, which would be the rate which he is charging. And if that is not available, you see your own incremental borrowing rate, as if you would have borrowed money from the bank or from the market, at what rate you would have been able to raise it. So simply accounting treatment for lease would be just see what are your committed lease payments under the agreement, get the present value of it using an applicable interest rate, and that is your lease liability to be recognized. The beautiful part is that this lease liability is also the value of your asset. So Ind AS 116 runs on the principle that you calculate for a lessee what is the liability for him, and the same value will be treated as a value of asset, which essentially means that when I enter into a lease agreement, I simply recognize an asset and a corresponding liability equal to the present value of the future lease payment. The asset is recognized in the name of right of use asset. There would be obviously some adjustments subsequently done on right of use asset in case if there are any initial direct cost improvements. So those nitty-gritties could be discussed as a part of 116. Now, the question here is that I am acquiring a company which is already having a lease agreement in place, right? So what would be the accounting for the acquiring company of this existing lease with the acquiring? Just to give some context to this scenario, let me take an arbitrary example, and this purely hypothetical. Let's say Inox, or let's say Knox, is acquiring a cinema, which is, let's say, Nataraj or Raj Limited. So this Raj Limited is running one single cinema hall, and I'm acquiring his or its business. So it's a business combination. This Raj Limited is having this cinema hall constructed on a leasehold land, which it had acquired from the municipal authorities under a long-term lease, which is, let's say, for 30 years. This lease was acquired 10 years ago, so it still has 20 years remaining period. Whatever be the accounting which Raj Limited would be doing in its books at the time of business acquisition, what I'm going to do is very simple. I'll follow the principles of Ind AS 116, which will say that what are the future lease payments which are committed by the acquiree, which is now my entity or my business, because I've acquired it. So I would say next 20 years, what are my committed lease rental? The Ind AS says that you will use the current interest rate instead of the interest rate which the lessee was using, because now the acquiree was using, because now it's my entity. So discount the remaining lease payment with your current applicable interest rate and determine the value of the lease liability. That would be the lease liability on initial recognition on business combination. And using the same principle, we will recognize the same amount of right of use asset. But there is just a small catch here. It could so have happened that Raj Limited or Nataraj Limited would have taken this lease 10 years ago. And let's say this is a cinema hall in South Mumbai, very premium location. And the lease rentals were very, very low because it was an old lease. Today, if I go and want to explore or take or enter into a lease agreement in a similar situation or a place, the lease rentals which I am going to pay possibly would be 3 times of what lease rentals Nataraj is committed to pay. Which essentially means that Knox Limited, when acquiring Raj Limited, would have this in their consideration that yes, by getting this particular company, I am getting an added advantage. What is that advantage? That I am going to, or I am able to use this space at a lower lease rental for next 20 years. Ind AS says that in case if you feel that the right of use asset which you have recognized has a higher fair value, then you can recognize an additional intangible asset for the difference. So this is going to create a very unique kind of an accounting, which will nowhere be relating to, accounting standards would nowhere be touching upon on these aspects, but Ind AS goes into those level of depth. And the logic is very simple. If I would not have done this and recognized an additional intangible asset, what would have happened? If you would guess, you would simply say that, obviously, when I had acquired that particular Raj Limited, I have paid a hefty sum just because it has a premium property on lease for the next 20 years. So you are paying extra money to that company, not for the goodwill only, but substantial amount of that is for the lease. Now, if I don't recognize the intangible asset, what happens? As Ganeshan sir said, that balancing figure is goodwill. So if I don't recognize intangible asset, the value of my net assets acquired would be lesser. My consideration is already fixed. So what will happen when this reduces, the balancing figure, goodwill increases. But if I recognize an intangible asset, I will actually recognize goodwill only for the residual value. So Ind AS principally says that if you acquire a business, the acquiree already has a lease agreement. First, calculate the lease liability using present value of the future committed payment using current interest rates. Correspondingly, book a right of use asset of the same value. If the fair value is greater, additionally recognize an intangible asset. It could also happen that the lease rentals committed are more than the market rents. Then in that case, you will have to recognize a negative asset, which essentially would be that you will reduce the value of the right of use asset. I'll just try to simply kind of clarify what the topics lease and business combination is. Obviously, when you get into the nitty-gritties, there would be more complicated calculations and other stuff involved. But principally, this is the way you would account for a lease.
Thank you so much, sir, for this elaborate answer. And next question to you, Sarthik Jain sir also. Please explain when the amalgamation would be considered or treated as amalgamation in the nature of merger or in the nature of purchase.
Okay. So if you're talking about accounting standard 14, as I mentioned earlier, accounting standard is a very format-based, provision-based standard. So it specifies the provision and there are those 5 principles which you follow. If you satisfy those 5 conditions, it is amalgamation in the nature of merger. If any of those 5 conditions are not met, it will become amalgamation in the nature of purchase. That's about it. What are these 5 conditions? Let me first tell you the condition and the logic behind it. First condition under AS 14 is that you need to acquire all assets and liabilities. Should I also acquire the contingent liabilities for it? The accounting standard does not get into those many details. So it says all assets and liability. Second, it says you will have to acquire them at their book values, which means you will not revalue them. Third, you will continue the business of the acquiree, the entity which you have acquired. Fourth, at least 90% of the equity shareholders of the selling entity, the target company, should agree to this scheme of takeover. And to these agreeing shareholders, your consideration should be discharged in the form of your own equity shares, except for cash for fractional shares. So all assets liability taken over at book value, business to be continued, minimum 90% equity shareholders should agree to this particular scheme and the agreeing shareholder will be discharged in form of equity share except cash for fractional share. Here, if you have an accounting policy difference, you can do adjustments to the assets liability value for changes in or synchronizing the accounting policy. All these 5 conditions met, it is a merger, pooling of interest method applies. What was the logic behind this? Accounting standard 14 said that if you are meeting these 5 conditions, it is not A taking over B. In fact, it is A and B getting together and doing their business. When it is not A taking over B, you should not be recognizing any new goodwill in the books because these are 2 businesses which are getting merged and running as one business. Why do I say these 2 businesses are getting one and running as one business? Because principally, I am not revaluing the asset liability. I am not being selective as to what do I want to take from them and not. I'm taking their whole business, running it, and their equity shareholder are becoming my equity shareholder. Hence, this is going to be a merger. But if I compare this with Ind AS 103, 103 goes on a very different and more simplistic logic. It says whether the control is same pre and post acquisition. If that is the case, it would be a common control transaction, what we used to call merger under amalgamation AS 14. And if the control has changed, it would not be a merger pooling of interest and would be a business acquisition. A simple small example, long years ago, Kingfisher acquired Air Deccan. Gopinath was running this particular company, and Malia ji offered him an equity stake in Kingfisher Airlines. Assuming hypothetically all conditions were met of Air Deccan, that all assets liability taken over at book value, business was continued, equity consideration was given to equity shareholders. This would sound like a merger, but in the merged entity, the owners of Air Deccan had hardly 5% or even lesser, I'm just taking hypothetical numbers, in the new entity. As per accounting standard, this would satisfy to be a merger because all 5 conditions are met. But under Ind AS, this will not be a merger because there is a change in control. This Air Deccan company was controlled first by someone else. Now it is under control of someone else. Hence, here you will not be able to apply the business, the pooling of interest method or the merger accounting. You will rather treat it as an acquisition of business.
Thank you. Thank you, sir. Now my next question to Ganeshan, sir. What is the treatment to be given in respect of reserves of transfer company?
Yeah. Before I start answering this question, I must appreciate the way in which Shardak has explained the subtle difference between the pooling of interest method in AS 14 and what is required to be done for common control transaction. Both of them are accounting are similar, but the logic behind applying in AS 14 pooling of interest method and common control transaction as per Appendix C of Ind AS 103 very nicely brought out. So you made my life little easier for this answering this question. Whether you take AS 14 or you take Ind AS 103, when we are talking about pooling of interest method, the first point which they are saying is the identity of the reserves will be maintained. So, for example, if I talk about A company is merging with B company, and the retained earnings of A plus retained earnings of B will be shown as a single line item in the merged entity. So, otherwise, retained earnings will be retained as such. Suppose if there is a capital reserve in A and capital reserve in B, then I will again aggregate and show as a single item. Suppose I don't have any specific reserve, say for example, for some statutory provisions, the acquiring company has created a reserve, but acquirer is not having anything like that. Still there is a reserve, and that is arising out of your pooling of interest method. The identity of the statutory reserve has to be maintained in the acquired entity or the merged entity. You have to retain that particular identity. So that is what exactly is happening only in respect of your pooling of interest method is applied as per AS 14 or your guidance given in Appendix C of Ind AS 103 for the purposes of accounting for common control transaction. The reserves, the identity of the reserves will be maintained in the merged entity, to make it very simple.
Right, sir. Thank you so much, sir. Now, next question to Sarthak Jain, sir. What is the treatment given to the goodwill which arises on amalgamation in the nature of purchase, and what factors are to be taken into account in estimating the useful life of goodwill?
Okay. So we are talking about accounting standard here, and under AS 14, what is the accounting treatment for goodwill? So first, the initial recognition happens on the balancing figure basis, which is nothing but your purchase consideration over and above the value of your net identifiable asset. Second, what do? You show that goodwill in the books with certain disclosures as a part of intangible assets under accounting standard. Under Ind AS, we show goodwill and other intangible assets separate line items. Third, you asked about how to estimate the useful life of goodwill. That question comes in because under accounting standard, we need to amortize goodwill. Under Ind AS, we don't amortize it at all. We just do an impairment check annually. Now, because we have to amortize, we need to use a life. It's very difficult to estimate life of goodwill. In our younger days, when we used to do, when we used to study CA, we used to study partnership. There we used to have this concept of super profit for n purchase years for calculation of goodwill. That more so is a theoretical concept, because usually when you buy a company and you get its goodwill, it's not acquired for 5, 7, 10 years. It's indefinite life. But because accounting standard requires you to amortize it specifically, accounting standard 14 itself states that you should take a prudent estimate of life. It is going to be difficult to estimate the life. Hence, usually the life should not be more than 5 years, unless a higher or extended life can be justified. So in that sense, if I've acquired a company which is a particular company which has a specific life set itself. Let's say, for example, I'm acquiring a company which is having a marketing rights or franchisee rights for McD's in India. And they have this right only for the next 5 years. After that, the company is going to shut down. So I can say that the goodwill life is 5 years relating to that company. If say that the company has a life of 7 years or 3 years, I can take that as a base. But otherwise, if you cannot estimate, you should use a life which is not more than 5 years and amortize it over that particular period.
You're on mute. You seems to be on mute.
Yeah, thank you. Thank you, sir. Next question to the nation, sir. What are the practical challenges that entities may face while calculating goodwill or gain or bargain purchase or capital reserve while accounting for acquisition of stressed business?
Okay. I believe that this question is arising from the background that a gain on bargain purchase very rarely arises. When I'm buying another company, the other company will never ready to sell below the value of its assets. So, or maybe net of assets, net of its liabilities. So if I'm paying some money lesser than the net value of the assets and liabilities taken over, AS 14 is silent on that. So AS 14 is very simply saying that the difference is capital reserve. Whereas Ind AS 103 gives little bit of guidance. What it says is that when the standard requires you to identify the fair value of the assets and liabilities as on the date of acquisition, how it is possible for somebody to sell the assets at a price lower than its market value? So very rarely it arises. And accordingly, when we are taking an example of a stressed company, there could be a possibility of forced to sale. So they have to sell at a lower price so that they require a cash flow. On that basis, there could be a forced to sale which they are actually making. Let's look at first what would be the situation with respect to your goodwill. To my mind, there will not be any major issues with respect to goodwill, because when you recognize all the assets at its fair value, less your consideration, so you will definitely know what is the fair value of various assets which you are taking out from the stressed business. Even if you believe that certain assets will not be realizable, you are actually removing it, only taking the fair value of the assets. And accordingly, what you determine as the amount you paid excess, that should be some business reasons. So if you understand the business reasons based on maybe to kill a competition, I am doing it, or maybe I have a synergy to take that business and run the processes properly, as we have earlier seen one example where Shardak was explaining in detail. So if I'm having a synergy, because of that I'm paying excess, then the straightforward accounting is on goodwill. I do not think that there could be a possibility of accounting for the goodwill. Only practical issue will be how I will amortize the goodwill under Ind AS 103. AS 14 is very straightforward, 5 years or extended period, depending upon the facts and circumstances of the case. But here, testing for impairment on an annual basis, I have to be under very cautious note to see whether the assets I have taken over from the stressed business still have the value, or it has to be tested for impairment. That is on the goodwill. Otherwise, the accounting for goodwill for a stressed business, I don't think that when I am acquiring a stressed business, I will have any problem. But when it comes to bargain purchase, if I have paid a lower amount or consideration, because I could arm twist the other person, they need money, so I'm arm twisting and getting a bargain purchase from that particular transaction. That gain according to Ind AS 103 compared to IFRS 3, IFRS 3 says it should be taken to the P&L straight away. But we have taken a carve out where we said that it should be either recognized in capital reserve or through the other comprehensive income, we have to recognize it as a capital reserve. But still, we have continued to have the same principles of IFRS 3. IFRS 3 is more cautious because it is taken straight away to the P&L account and offered as an income. But when we have done a carve out also, still we are wanted to be very cautious. What the standard says is the moment you are having a gain on bargain purchase, which results in a capital reserve, which you are recognizing as part of this, before recognizing that capital gain on a bargain purchase, you should reassess whether your working is correct, your fair value of assets is correct, your fair value of liability is correct, whether there are any other identifiable assets which you are taking over is not actually going to be an asset, or the fair value we have attributed for a particular asset is actually not correct because it's a stressed business. I might have taken a fair value higher and I have to consider doing another discounting. By doing this, if the asset value comes down, automatically the gain on bargain purchase will also comes down. So it gives a guidance that you have to reassess whether the fair value determined for your assets are correct. Maybe you have taken a higher value, now you have to revisit that, or the fair value of various liabilities, or maybe some identifiable liabilities are not considered, revisit and identify those items and take that also into consideration, based on which ensure that the gain on bargain purchase has been determined appropriately and not taken just like that as a simple deduction between the net assets taken over and the consideration. So this practical issue to revisit may be a challenge for the acquiring company when they are allocating the purchase consideration to various assets and liabilities. There may be additional help required to revisit when there is a bargain purchase. The experts may be involved for the purposes of determining whether the value taken is correct or not. That is what I believe as a practical issue which we have to consider when we are recognizing a gain on bargain purchase.
Thank you so much, sir. With that, again to Ganeshan sir, please. There's a company, A Limited, transferee company, amalgamated with B Limited, the transfer company, and there are certain intercompany balances between these two companies on the date of amalgamation. Please advise as regards the accounting treatment for these intercompany balances.
Maybe again, there is a guidance which is available. Pre-existing rights or obligations when we are accounting for a business combination. So even when you are having an equity investment also, there is a guidance which is available. So we are not taking that example here. What you are talking about is only intercompany balances like a payable or receivable or advances or loans, whatever you have given. So in that case, when I am taking over the assets and liabilities into my balance sheet, I have an asset in my books and there is a liability which I am taking over. When I am taking over that, I have an obligation to settle that liability. In case if I owe money to the acquiring company, I have to settle that liability. So to that extent, the cash flow which I am supposed to do is a pre-existing right or pre-existing obligation that is outside the purview of my assessment of my goodwill or my fair value of assets taken over, liability taken over, etc. Because it will be nullified at the same value. If it is an asset to be realized from the other company, I'm expected to realize outside my business combination. So it is not part of my business combination accounting at all. It is like a settlement of any other trade accounting or trade payables, trade receivable, loans, advances, whatever you are talking about as intercompany balances. So you should not consider it as part of that for the purposes of arriving at what is the net assets taken over, net liability taken over. You have to reduce this amount also because it's going to be settled after adjustment of this number. So accordingly, the trade receivable which you are taking should be less of what is the trade payable the acquirer has to pay before the date of acquisition. Similarly, if there is a loan which you have to collect it, the amount of liability should be net of this particular amount. That's the way in which you have to take into consideration the pre-existing liabilities and pre-existing assets before you account for the business combination. I think I have considered the question which you have given. Anything, Shraddha, you wanted to add up on that?
Precisely, sir. I mean, you covered everything that in terms of intercompany. So I understand that primarily one, there are balances. There is one also a possibility, like in case if these two companies, because the question was not touching upon that, but just as a thought it came across, that it could so also happen that the acquirer and acquiree has some kind of a legal tangle between them. Let's say, for example, an outstanding legal suit which has been filed by the acquirer on the acquiree before the acquisition. So even I think that also is another consideration which would affect your consideration.
Exactly. Because the concept goes with the net as fair value of net assets taken over. These two are pre-existing liabilities or pre-existing rights which you have to settle outside the accounting for business combination. That's what you have to consider.
That's the principle. Okay.
Yeah, thank you, sir. Next question to Sarthak Jain, sir. Treatment of reserves arising out of amalgamation in the nature of merger, whether reserves created out of amalgamation available for distribution as dividend or issue of bonus shares.
Okay. So merger, if I specifically talk about under accounting standard, because the whole logic is that two entities getting together and running as one, nobody acquiring the other entity, is just that we are getting together and working together. Hence, the reserves would continue to meet their existing phase, and hence their usage would be as per the existing terms. So to answer your question, A and B Limited merge into a new company C Limited, satisfying all the conditions of merger. So I would add up all the reserves and bring them together, which would mean that the general reserves also would be added one-on-one. The P&L surplus balance would also be added. Statutory reserves will also be added line by line basis. Can these general reserves be used for the purpose of distributing dividend? The answer is because the nature of the reserves remains the same. And since general reserves are free reserves, you can use it to distribute. However, it could so happen that when you do such kind of merger, it may have some legal implications under the Companies Act. And it may so happen that these mergers may not be possibly done unless and until you get an approval of that from the court. So usually under the Companies Act itself, you will have provisions with respect to amalgamations and restructuring requiring court approval in certain cases. And acknowledging this fact, Accounting Standard 14 specifically says that if it is an amalgamation in the nature of merger approved by a court or a similar authority, and they have prescribed any specific conditions or treatment for the reserves, those conditions and treatments would be followed. And whatever accounting standard says, I would say that that would be subject to the scheme approved by the court. So in case if the court specifies that whatever were the mergers of both the entities will not be distributable as dividend, then in that case, they will not be available for dividend. Accounting standard also would mention that you need to give specific disclosures with respect to that, wherein you primarily have to give 3 disclosures, which essentially would tell that you're not doing a treatment which is prescribed under the accounting standard, what is the reason for it, and what different treatment are you doing for it.
Right, sir. My next question to Sir Ganeshan, sir. Is workmen's compensation funds is included in accumulated profits?
Maybe I need a little bit of explanation what exactly you are trying to look at the employee compensation funds. I'm not very clear about the question.
Yeah, sir, suppose there are provision for doubtful debts and some provisions are made in the balance sheet. So will that be accounted or included in accumulated profits?
Provision of doubtful debts and employee benefit funds, I'm not able to.
Okay. Right, so we will move to next question.
We will park this and we will revisit this particular question.
Yes, for sure.
Because if we know the background, we will be able to answer that.
Yes, sir. This question is for Sarthak Jain, sir. Do the following items acquired qualify as assets which can be recognized in business combination? First is assembled workforce. Second is contingent assets. Third is potential contracts with new customers. And fourth is future contracts renewals. So will these be constituted as assets?
Okay. So here we are talking about four things, whether can be recognized it as an asset or not. In this, for contingent asset, the condition is very clear. Ind AS Amendment Rules 2022 specifically mentioned that though contingent liabilities usually are not recognized, but we still measure it while we calculate the net assets, as sir was explaining. For contingent asset, the clarification is very clear that you cannot recognize contingent asset on a business acquisition for the simple reason that it is contingent in nature and prudence applies. Talking about other than contingent assets, if I talk about, let's say, assembled workforce or potential contract renewals or potential customers, can I recognize them as an intangible asset or an asset on business acquisition? So here we'll have to first understand the basic principle of recognizing an asset. The basic condition, if you want to recognize an asset, is you need to have or you need to establish control over it. I have a son, he's brilliant in his studies. He has a very brilliant mind. He's doing very good business. In fact, he started earning money also. But he's not spending any of that money on me. Neither is he giving any share of that to me. In fact, I am feeling that I'm not even able to control him. He's absolutely under control of someone else, which I don't want to. And that's just a hypothetical case. What I'm trying to say is that someone else would be possibly treating my son as her asset or his asset rather than me treating it. What I'm trying to say is unless and until you're able to demonstrate control, you will not be able to recognize asset. This is further elaborated and explained under Ind AS 38 intangible assets, because there you have a bigger problem of control establishment. Now, if I'm talking about I have an assembled workforce, do I have a control over that workforce? How do I get control? Either it could be through a legal contract, or it could be through a fact that I have a control that I can separate and sell them on in the market. These are essentially two conditions which help you to establish identifiability, which is another condition for intangible assets. So what we are basically talking about is if I have an assembled workforce, do I have a control that I can control them, saying that you will have to work with me for n number of years, you'll have to serve under my guidance or in my company only? The answer essentially would be no. Same would happen for customer contracts or what we call as customer loyalty or potential contract renewals. So in any of these cases, the answer would be, I will not be able to recognize an intangible asset on them or any asset on them unless and until I am able to demonstrate control. Now, let's say, for example, if I'm buying a particular company, let's say that I'm acquiring an IPL franchisee. Now, that franchisee is having a set of contract with its workforce, which is players, which is guided or controlled by a contract. Wherein they have a contract, then let's say, for example, signed a player for 5 years. And they have signed similar number of players for 3 years, 5 years, 10 years. Can I recognize that workforce in my books as a separate asset? Then obviously the answer would be yes, because I am controlling the right of those particular players by means of a contract. So to answer this particular question, I would rather put contingent asset, you cannot. Other situations, only if you can demonstrate control, which usually will not be possible in cases or examples mentioned, you will not be able to separately recognize them as an asset. What will happen if you don't recognize it as an asset? Everything will get subsumed in goodwill, because you don't recognize a separate asset, but your consideration is still the total amount. So automatically your residual value goodwill will increase. There's just a very small exception. I don't think we need to get into those particular details also. But yes, in case if there is a condition of reacquired rights, wherein you had given your rights to somebody and you are acquiring that particular company and hence your given license is coming back to you. In those cases, Ind AS specifically says that in that case, you will recognize that particular asset in your books. However, in that, any renewal options, if you have, you will ignore that for the purpose of determining the fair value. But I think that's a very specific exception of 103, which is not principally by and large what the question is about.
Thank you
I
so
hope
much.
so that kind of,
Yeah.
Did I miss anything on this?
No, you have
No,
covered.
you have covered all the thing. The key point is having control over the subject matter, then only we can recognize it as an asset.
Sure.
Yes, sir. So next question to Ganeshan, sir, please. Suppose there is a company, A Limited, who takes over the textile business unit of B Limited for a purchase consideration of say rupees 10 crores. B Limited has separate verticals in textile, retail and IT sector. The purchase consideration to be discharged is by issue of equity shares of A Limited for the equivalent amount. Please advise whether same amounts to amalgamation as per AS 14.
Okay. Because it's specifically with respect to AS 14, I will restrict my answers relating to AS 14. You remember that the 5 conditions which Shardak was explaining to determine what is the amalgamation and the nature of merger which you have to account for, and what are all the other items. So if the 5 conditions have been satisfied, then you will be going for pooling of interest method. If it is not satisfied, you will be considering that it is amalgamation in the nature of purchase. Now the question here is, the very first condition which was mentioning for pooling of interest method is that you are purchasing all the assets and liabilities of the other entity. Here, in the example, you are talking about 3 different vertical. One is textile, one is what you are saying is retail, and another is IT. Right? There are 3 sector vertical, and you are only taking over the vertical relating to textile. I assume that all the assets and liabilities relating to the vertical of textile is being taken over. It is not just purchase of asset. If it's a purchase of asset, then AS 14 will also not apply. We have to go again to purchase of an asset under AS 10 or maybe AS 26 as a case may be. In this example, I assume that the entire business of textile unit has been taken over, and the IT sector, IT business and the retail business is not taken over. The only question now is whether I have to take all the 3 verticals to qualify for an amalgamation accounting under AS 14. The answer is no. So I am spinning off one particular unit to another entity, or maybe I can say it's like a spin-off of one unit and making it as a separate saleable unit. And that saleable unit alone, the acquirer is ready to acquire. The only question which is being given as a twist here is that the settlement is being done by means of issue of shares, right? So whether by issuing shares in the company will make this particular transaction as not falling under AS 14 is what we have to look at. My understanding is even if you're looking at your objective of this particular standard, AS 14, objective of the particular standard, it doesn't prohibit a case where you are taking over either full or part of the business of the other entity, for which you are actually taking both assets and liabilities or predetermined assets and liabilities and then taking over that particular item. Still, it qualifies as an amalgamation. So accordingly, in my view, in the given situation, even if you are taking only one vertical, that is a textile unit, if we believe that the entire assets and liabilities of the textile unit has been taken over, then it will qualify as amalgamation. Since there is no specific point which has been given that only the assets have been taken over, etc., I assume that it's a business, and accordingly, business combination will apply even under Ind AS 103. Even if you apply Ind AS 103, still it can be considered as a business combination of a particular business. So because it's a spin-off of one particular unit and you get the control over that.
Right, sir. Thank you, sir. Next question to Sarthak Jain, sir, please. Suppose there is a company A Limited which acquires 70% of equity stake in B Limited. Please advise whether the same can be treated as an amalgamation, and if not, then how would the same be counted for?
Okay. So the question is that A Limited is acquiring 70% of equity shares of B Limited. Am I right?
Yes.
Okay. Which essentially means that the legal existence of A Limited and B Limited would continue.
Yes.
It would be just that now I have from the shareholders of B Limited acquired 70% holding in B Limited. So I can visualize that A Limited would be showing this as an investment in B Limited, and B Limited will continue its business legally in the same manner, though there could be a change in management. Now, because there is no absorption or amalgamation, which means there is no entity or business which is shutting down and getting merged or absorbed into another company. Rather, both the legal entities are working as it is. It will not be treated as an amalgamation absorption accounted under accounting standard 14. However, because A Limited has acquired control over B Limited, in this case, not by absorbing the company, but by acquiring the controlling stake, it will become its subsidiary. And since B Limited has become A Limited subsidiary, accounting standard 21 would get attracted, which essentially would mean that from now on, A Limited will have to prepare two sets of financial statement under the Indian context. One, standalone financial statements, which would essentially be showing investment in B Limited, equity shares 70%. And second, consolidated financial statement, wherein I would show A and B combined as one entity, applying all the principles of AS 21. So essentially speaking, we can conclude that if there is an absorption of an entity or a business of that particular entity into my business, then AS 14 would apply. However, if there is just an acquisition of control with acquisition of shares, then accounting standard 21 consolidated financial statement would apply. This is with respect to the accounting standard. Ind AS obviously is on a different context. 103 would apply in both the situations there.
Right. Thank you, sir. My next question to Ganeshan, sir, please. So there's a case study, sir. A Limited, a transferee company, merges with B Limited, transferor. Both the companies are in similar business, and the amalgamation is amalgamation, the nature of merger. All assets, liabilities, reserves of B Limited would be taken over at book value. B Limited follows WDV method for depreciation in respect of its assets, while A Limited follows SLM for depreciation. Further, B Limited follows weighted average method for stock valuation, and A Limited follows FIFO method. In order to align the accounting policies, A Limited wants to change the accounting policies of B Limited and arrive at new book values at the time of amalgamation. Please guide A Limited.
Okay, interesting situation, but it very commonly comes in any amalgamation or any business combination. In the example which you are talking about as merger accounting or pooling of interest method, if I go with the AS 14, because specifically the question is on AS 14, if I am talking about AS 14, if I go by the standard, it says paragraph 10, if I'm not wrong, says that under the pooling of interest method, all the assets and liabilities are considered at the existing carrying amount. So no adjustments will be done. But there is an exception which has been given in the same paragraph. It says that subject to the items which are considered under paragraph 11. In paragraph 11, they are specifically talking about when you have conflicting accounting policies, the existing carrying amounts will be first brought to the same level. That means uniform accounting policy. Any adjustment, you have to recompute your WDV or recompute whatever number which you are talking about in the present case. In the present case, you are talking about one is the inventory and another is the depreciation on property, plant, equipment. So you have to recompute the carrying amount as on the date of merger by using similar accounting policy, and then merger has to happen. Otherwise, what happens is it is like comparing apple with orange and trying to merge it. Because it's a merger, it should be similar items. So we have to brought it as a similar item. So under AS 14, the answer is very, very clear. Whether we have a similar situation under Ind AS 103, because the session is on business combination also. You know pretty well, as we started, pooling of interest method is applicable not as a policy choice, only where there is a common control transaction, that too based on Appendix C of Ind AS 103. In Appendix C of Ind AS 103, also they are using a similar terminology with a different language. AS 14 is using conflicting accounting policy, whereas Ind AS 103 Appendix C is using harmonizing the accounting policy. Both are same. So that means they are trying to identify that if there are different accounting policy, you are bringing them into the same level and arrive at or reassess or re-measure the carrying amount and then do the merger. So in this given example, we have to make an adjustment for the accounting policy relating to valuation of inventory. You have to use a common one. Similar to that, you have to use the depreciation policy also the same. So the preferred method, the question comes is, which entity has to remeasure its assets, whether it is the merging entity or merged entity. So my understanding is merging entity is going to continue, and accordingly, I give weightage for the accounting policy of the entity which is taking over the other entity, which is going to continue. So that accounting policy I will apply to remeasure and reassess the carrying value of the entity which is going to merge, and then I do the merger. So one problem arises is when I do that number, the balance sheet will not tally for the other entity, because when the asset may be going up or going down, to that extent, what should be the adjustment? Naturally, it will be adjusted in the retained earnings of that particular entity. In a common sense, it's a very, very simple common sense.
Yes. Thank you so much.
In fact, just to add on, sir, there is one, there are two things. One, I understand what would happen that if this was a case of not a merger, but a purchase, even in that particular case, we'll have to use a consistent accounting policy going forward.
That's correct. In fact, to supplement what Sadak has mentioned, if it is in the case of a purchase accounting or acquisition accounting, we will actually determine the fair value of the asset. So the moment I have determined the fair value of the asset, the accounting policies adopted by the other entity is no more my consideration. It becomes my asset in accordance with the value which I have attributed. Then I will continue my existing policy, and according to the old policy automatically goes up. Perfect.
Sure. True. Yeah. And one more thing, sir, that now under Ind AS, what they have done is they have said that SLM WDV is treated as an estimate. And
correct.
Ind AS 16.
Correct.
And they've also done a similar amendment in the accounting standard.
Correct. Because it's on a prospective basis.
It's
a prospective basis.
True.
But only one problem which we will be having is that whether that accounting estimate, which we are talking about with respect to because it's a very interesting point which he has raised. Previously, our AS 10 was saying that even a change in WDV to your straight line method, you have to recompute the depreciation on a retrospective basis and adjust the carrying amount.
Correct.
But in this particular situation, whether we can say that it's a change in accounting estimate, and accordingly, I can straight away take that number. It's a question mark. It's actually gray area.
True.
I believe that because I am taking over the asset at a particular point in time, there could be a possibility of I'm assuming that I wanted to reconstitute the number and take it. The other side of the story could be taken that view also, that it's only the fixed assets is only a case of prospective adjustment according to AS 10 revised. So accordingly, I will just take that and depreciate over the remaining useful life on straight line or whatever basis which has been adopted. Could be a possibility.
Perfect.
Thank you, sir. Now, next question to Sadak Jain, sir, please. Accounting standard is accounting standard 14 applicable to demerger?
Okay. So if you're talking about demerger, which means basically we are splitting the company into two, which means I had one company which was doing all the business, and either I have hived off one particular business into a new company, or I have split the company into more than one companies, which will be now operating as separate legal entities. So technically, my understanding is accounting standard does not prescribe the treatment for it. So essentially, in that particular case, our accounting would be based on the generally accepted principles which we follow. And usually, if it's a demerger, I think there should usually not be a change in control. The same set of owners, at least at the point of demerger, would be owning it. So ideal accounting would be that we will use the existing carrying amount in the first financial statement, or the first point of time the financial statements of the demerged entity would be prepared. But to answer your question, accounting standard 14 specifically does not give the guidance on that.
Thank you, sir. Next question to you, sir. What disclosures are required to be made in the first financial statements prepared after amalgamation orders?
Okay. So this is for me, is it?
Yes.
Okay. So disclosures under accounting standard 14, there are some specific disclosures which they demand in the very first financial statement, because for obvious reasons that you've acquired a particular company, so you need to give those disclosures additionally. Now, essentially what disclosures would be is you'll have to first prescribe what method of accounting have you used for your amalgamation, whether it is pooling of interest or purchase method. Second, you will have to give nitty-gritties in terms of what treatment have you done. In case, let's say, for example, if it is pooling of interest method, then you have to give some details in terms of the description of shares which you have acquired, what is the percentage of shareholding which is being continued. However, in case if it is in the nature of purchase, then you have to give details about what was the purchase consideration, how have you discharged it, how have you computed your goodwill. So those are certain stuff which you'll have to give. Apart from that, in case if there is any court approved scheme, as we mentioned earlier, for scheme which is approved by the court, you may have to give a different treatment as prescribed under the accounting standard. So in that case, you'll have to give information relating to that as well. And also an effective date of amalgamation, because that date is important for the point of view of your accounting in terms of determining the fair value and other things. So these are some disclosures which are specifically required in the first financial statement, very briefly.
Okay, thank you, sir. Next question to Ganeshan, sir. What are the factors involved in the identification of an acquirer in the case of business combination affected by a newly incorporated company?
This is a very, very practical question. I appreciate that you included that question here, because whenever we are having a business combination, say for example, A Limited acquires B Limited, but A Limited will not acquire B Limited straight away, or A Limited will set up, say, C Limited, and through C Limited, the acquisition may be happening. So if we look at the basics of acquiring, identifying an acquirer, we normally believe that C Limited will be the acquirer. But C Limited is a newly formed entity in the structure for doing all this transaction. And accordingly, even though there is no specific discussion about why we should not consider the newly formed entity as an acquirer, there's a specific guidance available in Ind AS 103. In fact, the application guidance which has been given, if I'm not wrong, it's on the paragraph B18, which says that a new entity formed to effect a business combination is not necessarily an acquirer. If a new entity is formed to issue equity interest to effect the business combination, one of the combining entity that existed before the business combination shall be identified as the acquirer by applying the guidance given in paragraph B13 to B17. Let us just extend our example. A Limited acquires B Limited, but the consideration is given through C Limited's shares. So only a new structure is being created in which C Limited is actually issuing the purchase consideration. Indirectly, it is being done. So now we said that C Limited is a newly formed entity, and accordingly, it will need not necessarily be the acquirer, because the idea of taking the control over the entity is not by means of a new entity. So the guidance says that forget about the new entity, look at the other normal guidance provided in the standard, which says that how you will normally identify an acquirer. For example, the acquiring entity is the entity which acquires control over the other entity. Whether A acquires control over B or B acquires control over A, we have to reassess. Okay. The second point is the entity which pays the consideration will be the acquirer. So if A issues shares through C to B, then A will be the acquirer. Instead of that, if the shares are issued by C, then we have to consider, B, then we have to consider B as the acquirer. Similarly, whose assets and liabilities are being taken over? In our example, assuming that these assets and liabilities are being taken over and shares or considerations have been issued, then A will remaining to be the acquirer, even though there is a new entity which has been formed. Like that, if we can go on giving the guidances from B13 to B17, and based on which we can identify who is the acquirer. In majority of the cases, we can simply conclude that which entity, A or B, which takes over the control. On that entity will be the acquirer. The accounting for the business combination will be done in that particular entity.
Thank you, sir. Next question to you, sir, only. whether acquisition date, fair values for intangible assets or investment property are to be considered as gross block or net block, and accumulated depreciation required to be determined separately.
Frankly speaking, I believe that it should be net of the asset, it's not merger. And accordingly, there is no question of I'm talking about taking over the accumulated depreciation as well. So if I'm not wrong, you are giving an example of an acquisition.
Yes.
So when I'm talking about an acquisition, I believe that I'm acquiring an asset at its fair value. The moment I'm acquiring an asset, the accounting will be as per the accounting standard, respective accounting standard. So if I go to Ind AS 16, what is my cost of acquisition as identified as the fair value of the particular asset? And accordingly, that will be my starting point and not the accumulated depreciation. So that is my view. Anything contrary, Shardak?
No, sir, I think absolutely perfect, because even if we acquire a second-hand asset, we'll record it just
Correct.
like the cost.
Correct.
So same principle
Correct.
should apply. I also agree to what you say, sir.
And only one question which may be possible is that what happens to income tax depreciation? That may be an interesting point, because in our accounting for fixed assets under IT depreciation, there is a concept which was saying that if two entities have been merged and the existing entities is having more than 51% control over the other entity, even higher price has been paid to acquire that particular asset, you cannot claim depreciation on the higher value. Only on the existing WDV it is given in the accounting standard. So accordingly, we believe that if I am having a accounting of a common control transaction, this will not arise, because I taking only at book values and I'm not paying extra that. So in case of acquisition of a business, I pay money, and accordingly, I believe that that will be the cost even under block of asset method. So they should not deny me any depreciation on that.
Thank you, sir. Next question to Sarthak Jain, sir. What is reverse acquisition and how is it accounted for as per Ind AS?
Okay, so this is another beauty of Ind AS, because Ind AS again goes with substance. So what it says is that, as Sir was mentioning, that if there are two entities, A plus B, and there is a new entity C, ideally either of them would have acquired and made a new entity. Now, what reverse acquisition exactly is? Usually, if I see a legal acquirer acquiring another entity, then in that case, I would say that this legal acquirer who's acquiring the other entity is the acquirer, and the other entity assets and liabilities are taken over, consideration is discharged, and difference is purchase consideration. Now, in case if the consideration is discharged in the form of equity shares, which means A acquires B. Let's say, for example, both the companies have a share capital of 100, and A says that I'm absorbing B or acquiring B, let's say, for example. So in that sense, I'm acquiring shares of B. And against that, I am going to give you my own shares, which means the consideration is being discharged in the form of equity shares. And what I say is that this exchange ratio, let's say, for example, would be 2:1, which means for your one share, I'm going to issue 2 of my shares. So what is going to happen is that A limited share capital was 100, B limited share capital or number of shares were 100. A has acquired 100 shares of B, and in discharge, it has issued 200 new shares to the owners of B, because I have acquired shares from B. Now, post this whole treatment, what has happened is, A would say that I have 100% of B, so I've acquired B. But essentially speaking, A share capital now is of 300 shares because it issued 200 new shares, which are owned by owners of B Limited. Which would essentially mean that A itself has lost control. That means owners of A no more have control over A. The control has gone to the owners of B Limited. That means the hunter has got hunted, or you could rather say that legally it looks A has acquired B or control over B, but in substance, it is actually B shareholder who are now controlling the combined entity. This is termed as reverse acquisition. Obviously, this is not something which will happen by chance. This will be a very well-planned and executed strategy. Why would somebody do like that, that I am acquiring another company and I am losing control over my own company? That usually would be a part of the whole package itself. Usually this would happen, let's say, for example, a list, because reverse acquisition is a complicated case. Suppose hypothetically, Reliance wants to get into the airline space. Now they find SpiceJet is already doing this particular business, so they want to acquire that particular company. Now Reliance wants to absorb SpiceJet. So if they absorb, what will happen is all their assets, the business, the processes, everything will come to Reliance. But the problem would be that if you have to run aircrafts on specified routes, you need to have licenses for that. Now these licenses are non-transferable. So if the company is shut down, then those licenses cannot be transferred to the acquirer. Those licenses also would be wiped off. So in this case, what possibly an arrangement would be designed is that SpiceJet legally would acquire, let's say, Reliance Aerospace. I'm just taking a hypothetical example, not to relate with any real acquisition, just for the sake of understanding, I'm giving some names. So SpiceJet would show that I am acquiring shares of Reliance, against which I am issuing my own shares to the owners of Reliance. Against that, Reliance will obviously issue some consideration to that particular company. And the new structure would be that SpiceJet would remain as a company, but the majority shareholding would go to owners of some other company. Accounting perspective, what is going to happen is the legal acquirer, in my example, SpiceJet, would prepare its financial statement in its own name, SpiceJet. However, it will recognize the assets of the other company at book value. So simply, the legal acquirer is actually not the accounting acquirer, whereas the legal acquiry is the accounting acquiry. So what will happen is financial statements would be of SpiceJet, but in that financial statement, the other company's assets and liability would be shown at its book value. And my own assets and liabilities would be shown at fair value. The consideration here would be, because now SpiceJet has, in my original example, 100 shares, I have issued 200 new shares to the other company. So in this particular case, the legal acquirer has 1/3 stake in this company. It will have to value those 1/3 stake. What is the consideration for it? So that would be the consideration minus the fair value of its own assets. That would be the goodwill. So technically in SpiceJet financial statement, we will show goodwill, which will be of SpiceJet itself. So legally, SpiceJet is acquiring Reliance Aviation, but actually it is happening the other way around. And that is why we call it as a reverse acquisition, because legally what is happening in accounting substance, that's not specifically the case.
Yeah, thank you, sir. There's a question from our audience. So how the value of the consideration be adjusted in the light of one or more future events? Sadhan?
Maybe I will take it up.
Yes.
If I'm not wrong, what they are trying to talk about, the provisional consideration or contingent consideration, which might have been received as part of the business combination. So in a business combination, there are possibilities how the payout is being determined. There could be a fixed consideration, which is very evident. And they may also talk about certain contingent consideration. For example, if I say that if the company goes for IPO in the next 3 years, I will pay you additional 10 crore. Or if the company's EBITDA is increased by 20% compared to what we are having in the next 5 years, I will pay you additional 10 crore or 20 crore, whatever maybe. So the problem arises here is we do not know whether the future event will happen or not happen. So it is like a situation where we are talking about a contingent liability or a contingent asset, where the entire thing is based on what is going to happen at the future event. The guidance which has been very explicitly available in India's 103 is how to account for a contingent consideration. It is saying that the acquirer has to determine, according to his own estimate, whether it is probable that the additional consideration will be paid or the conditions will be met for making the acquiree eligible for the additional consideration. In that particular situation, the additional consideration should also be part of the consideration for business combination and the day one itself. Suppose if it is not going to happen on day one, maybe I'm doing a provisional accounting. Because when you are doing a provisional accounting, you have to make a disclosure as part of the notes on accounts. If I give a provisional accounting based on what is the information available as on the date of acquisition, and the contingent consideration is not taken as part of that, and 1 year window is available for me to revisit, or maybe I can say that fine tune my estimate based on additional information which may be available, whether the condition will be met or not. If that is determined, then I can go back and reset all the numbers on a retrospective basis as per Ind AS 103. Suppose if it is not available within the 2-year period, and initially I have not made an estimate whether the contingent consideration is payable or not, I am not able to determine that. So in that particular situation, it will remain as a contingent liability, and I have to estimate every year. I have to revisit, and based on the future event, if it is happening, I cannot readjust after 1 year. I should only go and account it as a normal transaction. Having said that, there could be additional possibility also, because complexities may arise in various scenarios. Continuity of the business, the existing key members of KMP in the other company, for which there could be a possible consideration they have fixed. They have to continue for 5 years, for which there will be a payout of another 10 crore. The only problem people are normally making a mistake is whether it is a consideration as an employee-employee relationship, or it is a consideration to the promoters as owners of the business. It makes it very clear. If it is payout as owners of the business, then part of the consideration. If it is payout for continuing in employment, it should be accounted over the period for which the services are rendered. So accordingly, in this question, I believe that the contingent consideration has to be assessed in the same way in which I'm making it very simple, same way in which you assess a contingent liability or contingent asset, and based on which the accounting has to be done.
So there's one more question from the audience. Do potential contracts with new customers can be recognized as assets in a business combination? I think this is already answered.
Yeah, Shatak has already answered this.
Right.
Yes.
So just to repeat, the answer should be no, unless and until you are able to demonstrate control, which with the plain facts, you will not be able to.
Right, sir. So, sir, there are more questions, but with the lack of time, I'm not able to continue. I'm not able to deliberate all the questions. So thank you so much for the wonderful audience and our speakers and the Accounting Standard Board, who has organized this wonderful questionnaire. And this has really enhanced my knowledge on the Accounting Standard 103 and 14, because I have not thoroughly gone through that section, because it's not practically applicable for me right now. But I have learned a lot, and by moduling questions, I've learned a lot. And by your answers, I even learned it better. So thank you so much, Sarthak sir and Dr. Chinmay Swamy sir. And with that, I'm concluding the session. And if any questions, I'm just checking it. There's one more question. What are the two main differences between Ind AS 103 and IFRS 3, which is a yeah.
Maybe I can take up that question. If you see that in IFRS 3, when they have brought in that, before that they were having like what we were having as AS 14, amalgamation, as amalgamation, absorption, reconstruction is what is. They also had as an amalgamation accounting. So when they have brought in as business combination as a new standard, where they have removed a lot of accounting principles which were existing in the existing accounting standard for amalgamation, they are forced to bring in certain transitional provision in IFRS 3. But we have adopted IFRS 3 as Ind AS 103 straight away. And accordingly, whatever transitional provisions which were there in IFRS 3, we have already included in the respective standard. That's the reason why we don't have any transitional provision in Ind AS 103 compared to IFRS 3. That is one major item. And the second thing is maybe since we have experienced with common control transaction on a regular basis, we have considered the common control transaction as a separate appendix for the purposes of accounting, whereas IFRS 3 is not specifically giving any type of detailed guidance on that. So that is the two major thinking, mainly because whenever business combination comes in, it's a major business decision, major accounting implication. To that extent, I think that the entity should be given a little bit of guidance. That's the reason why they have brought in that additional concept as well. And others are a simple change of words, terms, etc. That is not a major item. This two. And of course, third one, which we have already discussed, IFRS 3 says that the gain on bargain purchase should be taken to the profit and loss account. Because they are saying it's a gain. You have negotiated, you got a gain. Gain means it should be P&L item. Whereas we have taken that, on the one hand, you are saying if you have paid higher amount, it will be goodwill and you have to test it for impairment. Whereas on the other side, when I have paid a lesser amount, it will be treated as my income. It's not fair. And accordingly, we have decided that we will route it either through OCA or treat it directly as a capital reserve. There are some guidances which has been given when you can take it directly to capital reserve, when you have to route it through other comprehensive income. So these three, I think that is the main difference between IFRS 3 and Ind AS 103.
Thank you, sir. Thank you for the session, and thank you all the viewers, speakers, and organizers for this wonderful session. Thank you, speakers, once again. Thank you.
I think that we should also thank you for testing our knowledge, first of all.
I am not the person to test your knowledge.
No. What I am trying to say is that very simple. Not necessarily that only to answer you have to have the brilliance, but also to set the questions, you definitely require a lot of brilliance, because one thing is you have to balance between the capability of the speakers, and another thing is you wanted to bring out all the important aspects for the knowledge of the audience. So you have done very well, and ASB should also be appreciated for setting that type of questionnaire. Yes. I'm actually feeling very, very comfortable with the parallel co-speaker Shardak, where he is coming out with a lot of examples, and he eases my role also, even though all the case studies have been given to me, but he has given a lot of clues for me how I have to handle the case studies. Thank you, Shardak, for that also. And thank you to ASB, Shalini, and all the members of the ASB, including the chairman of ASB, for this excellent opportunity.
No, sir, very gracious of you to give me that credit. But yeah, I was first and foremost, yeah, Mayuri should be really appreciated, because it's a very lengthy standard in two of them. And she's managed to cover all the questions, and the credit actually goes to the moderator for it. So really well done there. And thank you, sir. In fact, I was pretty amazed in terms of, the way you could kind of recollect all the concepts and the kind of knowledge which you are sharing, connecting things with one another, which really shows in terms of, how well you have things and tips, which is very amazing and a very learning experience for me. And definitely very good session. Thank you, ICI. Always a fan of ICI for organizing all such good stuff at such a large scale for members. Because I think, our body in that sense is giving so much that sometimes we take it for granted, which actually, if we compare with, the foreign or the other institute, there's no need to compare. But yes, it does, creates that kind of a differentiation. So all kudos to this institute and the Accounting Standard Board for it. Thank you so much.
Thank you, Shardak.
Thank you, sir.